So let's look at this world economy. We're not particularly concerned. There are valuations issues in some markets, we concede. But I think, or our feeling is, the world is gradually repairing itself. It is a gradual process. So if you look at the US, they've been given a rather lucky hand because firstly, they dealt with the problem pretty quickly. But the most important free kick they've got is this remarkable technology of extracting gas from shale. And it's often oversimplified because this is an extraordinary feat of engineering. What you're talking about is drilling through perhaps 3 kilometers of rock and then horizontally drilling another 2 or 3 kilometers, placing huge horsepower at the top of the well and fracturing this rock below. You do it through explosives, but then you break the fissures up with a high-pressure water charge. But remember, what you're actually doing is you're breaking material that is similar in strength to that of concrete. So it's an astounding bit of engineering, and when you think of the depths and you think of the size of the holes by the time they're up 5-7 kilometers from where you start, it is tiny. So with this has come not just gas, but the US, which had been a very large oil producer back in the 60s and early 70s, had seen diminishing liquids production, and in other words, oil. But with these gas finds, you're also extracting liquids. So from a base of a couple of years ago of producing about 6 million barrels of oil a day, the country's now getting liquids of about 9 to 9.5 million barrels a day. So it's a huge transformation of both liquids and gases. And so out of that is going to come a huge change in the economy because you've got low-cost energy. You've also got this rebuilding of their chemical industry, their refining industry, and so on. It's a big, big change. And off that, there's going to be a decent investment boom, and it's already started. So if you look what's happening, banks are lending again, house prices have started to move up, house starts are picking up quite nicely, industrial buildings are picking up. There's a general sense of progression, and importantly, wages are starting to pick up. And in places like the Gulf, where there's such a lot of activity, there's actually a problem with getting people. And this is a mobile country. This is where people do move around. There are trailer parks, there are quick building solutions. So the place will grow. And in our view, the government or the central bank, the Fed, will keep money relatively cheap. And the way we're tending to play the US is we're buying these companies which will be transforming that investment. So they'll be the companies that put in the plant that allows these gases and liquids to turn into chemicals and so on. We also have a large component of our US investment in their interesting companies like Google and so on. So it's a blend of old technology and the new world. Europe is interesting. We've had this extraordinary outcome at this election recently, where basically there's some concerns about too much intervention from Brussels. But the exciting part is just what's happened on the ground. So countries that have been in chronic current account surplus, like Greece, for the first time since 1949, is now in surplus, current account surplus. And you look what's happening in places like Spain. So their exports, which used to be about a quarter of the economy, are now a third. Jobs are slow in coming, I must acknowledge, but there is growth, and in some places you're seeing typical recovery of house prices, wages are seeing some pressure in 1 or 2 places, and it's not all bleak. But it is fragile, but the question is, where are the opportunities? And that's what we spend our time on, looking at rather than worrying about the big economic picture, because basically it's pretty well covered. We see good opportunities in the drug companies, which account for 9% of our portfolio. We see very interesting opportunities for these luxury good companies. They're far from lost their growth credentials. These companies will start growing faster now that the clampdown in China has pretty much revealed the underlying trend of growth in these, the demand for these products. And we like companies like Pernod, which is a drinks company, makes very good profits, and it's a global story. So if you look at the portfolio, we've got about 25% in the States and Canada, and about 25% in Europe. Then you look at Japan. Here's a place which we don't really want to take a view on the success or not of Abenomics. Will they get a change? We think it's highly likely. What we do know is the currency has dropped precipitously, and industry is now pretty profitable. So this last year, earnings for the market were up over a third. So it is changing. But the interesting thing to us is what's happening at the corporate level. So very proud companies like Hitachi have swapped assets with what they would have in former years regarded as an inferior company, which was Mitsubishi Heavy, and they've taken the junior role, which is unusual. Similarly, with their rail business, they've headquartered it in Britain. Their IT storage business, so that's memory business, they've headquartered in the States. These are companies which are changing. And now there's a really nasty tweak coming through, whereas there's a special index being formed, and for companies that are not profitable, they're simply eliminated from this index. And that's causing consternation because many of these companies are inherently profitable, but they're sitting on, or half their balance sheet could be cash, or a third of their balance sheet is cash, so they're not getting the return on equity that their American and European counterparts are. So many of them now are talking about buybacks, using more of their balance sheet in a more proactive way. So there's change happening, I assure you. And the companies we have in Japan are the great manufacturing companies which have the technology like Toyota, which is the world's biggest car company. And we love their telecoms business, which is going to probably grow at 15% a year in earnings, which is not going to be easy to find. But of all the big markets, perhaps the cheapest of all is Korea. And of course, the leading company in Korea is Samsung Electronics. Here's a leader in its field. It outsells Apple about 3 to 1 in terms of smartphones, and you can buy it on 7 times earnings. So just for perspective, many of you like the Australian banks because of the dividends. They're typically on 14, 15 times earnings. Here's a pretty interesting global company, which no one had heard of or much about 25 years ago, and now is a giant with 25% of its capitalization in cash on 7 times earnings. And the problem is that the competitiveness in producing these smart devices, pads and phones, is just intensifying. So Joe Lai, who runs the Asian Fund with Andrew, was on the phone to a Chinese producer, and he was pretty intrigued by this company because they'd miraculously produced a pretty decent 4G mobile phone and were selling it for $150. And Joe pressed him and said, well, why are you able to make any money out of this? And he said, well, we just took the punts and went with this new TD system that the Chinese have evolved, and we're first to market, and we're producing, I think it was about 10 million phones a month. So we have an advantage in terms of scale. And Joe said, well, that doesn't seem like a very durable advantage. He said, yes, you're right. He said, so when the competition catch up, we'll cut prices. So the world is just very competitive, but in fact, with Samsung, we think it's largely priced in for a more competitive world in phones. And there'll still be some premium for brands and so on. India, we think, is a very interesting market. We see huge changes coming from this election. We'll now have a prime minister who has a very clear mandate. We see a whole lot of things happening. And by the way, there were already things starting to change if you follow the country under the old regime. So there were already changes in place. So he doesn't start with a blank sheet, and he will now sharpen up the focus on a pro-growth mandate, which is very clear. We can talk about that perhaps in question time. And then you look at China. Now, China is the one place where you're going to hear a lot about the problems. We wrote about this a full year ago, and they're real. I mean, this is a country that is industrialized as no other. It has been a huge stride, and no one can really see or take issue with the successes they've had. But it's been at a huge cost, environmental in particular. And we're seeing the big change now is that hitherto many of the decisions were directed by the government and the provinces. From here on, it's going to be dependent on the individual and the private sector. You can't dictate to those folk as you can to your own employees and so on. So this is the transition. And I think the country will still talk about 7% growth, but it's highly unlikely that'll be achieved or achievable. The labour force is now stabilised, it's no longer growing, and indeed there's no country on earth, and certainly not of this magnitude, that has been able to grow when only a third goes to consumption and 48% goes to capital investment. It's just too high. Capital investment must come back as a proportion of the total. So it's a vast economy, and we can see it growing slower, but I will just point out a few things to you. Back in 2000, we had the banking system with around 40% of its loans were non-performing. In other words, people were not meeting their repayment of capital or interest. So it's been through some difficult times. The system's now much bigger and more sophisticated, but they will have some bad debts. Property prices are starting to fall. Property starts are diminishing. They're no longer starting as many projects as they were. There have been some losses from these wealth management products. That's happened, and it will continue to happen in our view. So there's going to be plenty of headlines, but here's the change. Under the new regime, this whole notion of clamping down on corruption is partly to clean the system, but it is also an exercise of power. It's an exercise of power to bully these very privileged state-owned enterprises into changing their activities. They, in many cases, have locked out private competitors. So yes, you can flap about wealth products, you can flap about the changes, but if you look at other countries where they've allowed the private sector to really get a bite on the cherry, you'll be surprised how it can change and bring through a lot more growth than you would otherwise expect. And the current president is very aware of this, and this is the pressure point. And because of all the vested interests in China, because of the structure of the economy and the whole social network, without that pressure point, he would be finding it extremely difficult to bring change to that economy. I believe he has the power and the will to pursue it. And you see it with this chasing down of corruption. You see it by the removal of people, and you see it by questioning of civil servants who have families abroad, and they ask why. So this is a country going through a huge change, and please don't underestimate the desire of people to get ahead and say, yes, there'll be the headlines, but I suggest the place will still grow at a decent rate. So we can take a lot more questions on that, but I don't want to dwell on that. So when you look at where we're positioned today, as I say, we've got about 25% in each of Europe and America, 14% in Japan, and the rest in Asia. Much, much more than most people think is appropriate, and we just know where the value lies. China, the Shanghai Index 6.5 years ago was over 5,500. Today it's 2,000. The economy has more than doubled in that 6.5 years. And when we showed you the deterioration in prices in the worst 5 years in the States, it was 12%. The Shanghai Exchange over the last 6.5 years has fallen by 14% compound. The market, we believe, is in a pretty serious way discounting a slowing in that economy. So by the time it's in the papers, it's probably too late. It's probably time to be buying that market now. So that's where we've got a lot of money, about 10%. We've got about 5% in India. On currencies, we have no Australian dollars, we have no yen, and we have about 30% in the euro and European currencies, 50% in the US dollar, and then bits and pieces in Asia. So we're about 93% invested, which for us is a pretty aggressive stance, and we have about 14% short. So we're about 80% long the markets, which is quite high for us. We are concerned about some valuations, but that's why we're tending to skew towards these places where the valuations are much more interesting.